Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA, SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Clear Vista Financial are not affiliated. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions.
Well, welcome everyone to the Spend Life Well show. I'm Certified Kingdom Advisor Mark Trice. Thank you for listening and joining us today. This is a show about where we apply biblical wisdom to your financial life. And as always, I'm joined in the studio today by my co-host and fellow financial professional, Jesse Hamilton.
Hello, listeners. Welcome to the show.
Hey, so today on today's program, we're going to talk about two big economic announcements, Jesse, that happened during the last week that are going to impact a number of our listeners' pocketbooks, okay?
Mm-hmm.
And that's inflation and Social Security. And we'll get into those and unpack those throughout the program today, but you can call us anytime with your financial questions at 254-282-0495, 254-282-0495. You can also send us an email at radio@spendlifewell.com. And Jesse, we're pretty good about getting back with folks on that, aren't we?
Yeah, we are. We'd love to respond to you within 24 hours, and we might even pull your question out for our mailbag on an upcoming show. We love to hear from our listeners. Once again, that phone number is 254-282-0495, and the email is radio@spendlifewell.com.
And if you want to send us a question during the program, you can actually text us at that number. Is that right, Jesse?
That's true.
Yes.
And for our friends listening on different channels online, just make a comment there in a box, and we'll see you live.
Great. All right. Well, let's jump into today's program. The verses that I chose for this week's show really were from the 41st chapter in Genesis. And it's not just a verse, Jesse. I don't want people to think, I don't want to read everything, but it's basically the story of in Egypt where Joseph was serving the then Pharaoh,
Mm-hmm.
and Pharaoh had a dream. Do you remember anything about that dream, Jesse?
Yeah, well, I mean, we got the verses here. Do you want to read part of the story or give the summary
Why don't you go ahead and do
version?
that, because that's relevant to our conversation today about
Sure.
inflation and preparation and stuff like
So
that.
Pharaoh said, "In my dream, I was standing on the bank of the Nile when out of the river came up 7 cows, fat and sleek, and they were grazed among the reeds. After them, 7 other cows came up, scrawny and very ugly and lean. I had never seen such ugly cows in all of Egypt. The lean, ugly cows ate up the 7 fat cows that came up first, but after they ate them, no one could tell that they had done so, so they looked just as ugly as before. Then I woke up."
And so also in his dream, he saw 7 heads of grain. They were full and good, growing on a single stalk. After them, 7 other heads sprouted, withered and
Yep.
thin and scorched by the east wind. And the thin heads of grain swallowed up the 7 good heads. And Pharaoh was really troubled by this. Of course, he
Yes.
talked to all his soothsayers and magicians and things like that, and none of them could explain it. But then
Then
Joseph, he heard this, and what did he say?
"The dreams of Pharaoh are one and the same. God has revealed to Pharaoh what he's about to do. The 7 good cows are 7 years, and the 7 good heads of grain are 7 years. It is one and the same dream."
So, and then the bad grain and the ugly cows came afterwards.
Right. There are also 7 years.
Right, and they're worthless. And what was God telling Joseph to tell Pharaoh?
That there would be 7 years of famine. Right?
Okay, great. And this gave Pharaoh the chance to prepare, right?
Mm-hmm.
If we know bad things are coming, yet there will be good times ahead, what should we do? We should prepare.
Right.
And this kind of reminds me of kind of our current situation. We know, now we can't predict the future. And as far as I know, Jesse, you haven't received any dream.
I haven't received a dream, and my crystal ball has not arrived yet.
Right. So nothing involving scrawny cows and and dried up wheat. So we don't know what the future holds. We have no way of predicting that, but we do know God is in control.
Mm-hmm.
And with all these different warning signs on the horizon, what does a prudent believer do? Well, they prepare for economic situations ahead of time. And that means by, developing a good spending plan, making sure you have an emergency fund, making sure that you're living within your means. And these are all relevant today just as much as they were back in the time of Pharaoh and Joseph in Egypt.
Mm-hmm.
And, now is the time to prepare for future events that we can't see. But having a well grounded financial plan is so critical to surviving any economic storm that might come ahead. Okay. So when I was reading through scripture this week, Jesse, and I said, this is a good reminder. Reading the story of Pharaoh and Joseph and how he helped prepare Egypt for a coming famine reminds us that we as believers need to be prepared for potential economic calamities, whether that be a famine or an economic crisis. And
Right.
the only way to do that is to follow God's design for our finances. And Scripture's full of wisdom about how to do that. So
Right. So
anyway,
we can't predict the future like Pharaoh thought he got through Joseph, but where it does get practical is Pharaoh was really the executive of the time of the country, and he had to
right,
make some practical decisions. I'm talking dollars and cents, practical decisions to make it in the future. So let's
yeah,
dive into maybe how some people can be doing that.
sure. But first, let's get into some news that happened in the last week.
Oh
The
yeah,
big
big
announcement,
big news.
Jesse, with Social Security. What happened?
They announced an 8.7% benefit increase for 2023.
That's huge.
That's huge, and that's for every person receiving Social Security income. That equates to about 70 million Americans.
Okay. And that means that the average Social Security recipient will receive roughly about $145 more per month.
That's a lot
And
of money.
that will make a big impact in retirees' budgets. Okay.
Hmm.
Now, we haven't seen a cost of living adjustment that large in well over 40 years.
Hmm.
When we do our Social Security planning for our clients, we're maybe factoring in somewhere around 1.5 to 2% inflation every year because Social Security recipients, even future Social Security recipients, receive that cost of living adjustment in their
Hmm.
calculations.
Right.
So if you are receiving Social Security now, you should get a letter in December showing that this will be your new monthly payment for 2023. If you aren't receiving Social Security yet, you'll be able to log in the first part of the year and see how much your projected benefit may have increased going forward. So this is a big deal, and if, I think this will be a big help to a lot of retirees because we have seen the cost of living go up tremendously over the past 12 months.
Hmm.
Now,
Yes, we have.
one thing that I'm not sure about, but it is in the press release for the announcement of the Social Security increase is, and Social Security says that Medicare premiums are actually going to go down. I have not seen that in many, many moons. So I'm hoping that's correct. Maybe perhaps they're going to freeze Medicare premiums this year. Medicare Part B premium is right around what, $170.10 or something like that, maybe
Hmm.
$171. And if they're actually going down, that's great. Normally, what happens though, so our listeners know, whenever there is a increase in the Social Security cost of living, um, there's usually a corresponding or not quite one-to-one increase in Medicare premiums. And we don't see that. Now, I don't know if that was part of the Inflation Reduction Act or what that may be. Now, that concerns me because the Medicare program is already in the red. This happened about a year or two ago where there are fewer benefits or premiums from our paychecks going into the system than there are going out. And so this tells me that the government is going to kick this can down the road when it comes to Medicare. So don't be surprised by future increases in future years.
Right.
So unfortunately, it's probably not enough to make up for the cost of that inflation has made on most people's household budgets, but it will help.
Is the COLA, the cost of living adjustment, based directly on the CPI?
In part,
Okay.
Jesse, and it's based on really the last quarter. They look at, I think, July, August, September rise in inflation, and because it was higher than expected, the COLA cost of living adjustments higher than we anticipated. So some other changes that are going to happen, Jesse, is the max amount of income that can be subject to the Social Security tax will increase as well. Have you got those numbers in front of you?
Yeah, so it was 147,000 and it's going to increase to 160,200.
So that just means that it's going to more of your paycheck, if you're making above that level, more of your paycheck will be going to Social Security.
Mhm.
So I wouldn't hold your breath on the Medicare. I know they're the same larger agency, but I'm surprised to hear that they're not going to increase Medicare premiums for 2023.
Mhm.
Now,
But
one thing, yeah, go ahead.
I was just going to say people don't necessarily have to wait for a statement to come. You can log in and see how this might affect you, right? They could log in
Yeah,
online.
I think they should be updated here real soon,
Okay.
if not already. Yeah.
That's
Now,
that's my Social Security, um,
now
ss.gov, I think.
SSA.gov,
SSA.gov.
SSA.gov. Um, now, one of the things our listeners need to be aware of, okay, because you noticed how the Social Security tax maximum will increase to $160,000, right?
Mhm.
Well, a lot of your income taxes, tax brackets will also increase. One thing that does not change, though, one thing that does not change with inflation is the cutoff limits for whether or not your Social Security income is subject to income tax.
Hmm.
You know, if you're a married couple, all right, and you're both receiving Social Security, and you make above $44,000 in provisional income, according to the Social Security Administration, uh, about 85% of your Social Security income is going to be subject to income tax, whatever your income tax may be. Right. Okay.
Mhm.
So those aren't changing. So people are automatically getting 8.7% more in Social Security benefits, and that could very easily push someone that wasn't in a taxable bracket for Social Security this past year. Suddenly, now they're getting the Social Security taxed,
Right.
and provisional income, according to the Social Security Administration, is any W-2 wages. Okay, so if you're working in retirement, W-2 wages, any type of income that's generated from withdrawals from retirement accounts. Okay, and any non-taxable interest that you might receive. So if you own municipal bonds, those are generally exempt from federal income tax, but they are put into the calculation to determine whether or not you are going to have to pay income tax on your Social Security benefit. So, folks, this may be confusing. I understand it's a lot of gobbledygook to kind of cover, but give us a call anytime. You can call us at 254-282-0495. You can also just visit us on our website. You can make appointments there at spinlifewell.com. That's spinlifewell.com. So, Jesse, I was in preparation for our show this week, I was
Mhm.
trying to search the scriptures to find examples of inflation.
In the
And
Bible.
in the Bible, right?
Okay.
In the Bible. And no, you can't go to your concordance in the back and look for the word inflation. But there were a number of different instances, and I apologize, I didn't write down all the scriptures, But there were a number of different instances where things that God was admonishing were things that would cause inflation. So you remember the scriptures about using honest weights. I know there's verses in Proverbs and
Right. Hmm.
different places like that. Use honest measures and things like that. People would cheat and cause the price of something to be higher. Well, guess what? That's an example of inflation, and that spreads throughout our biblical economy, if you will.
Hmm.
And so there are plenty of examples of back in biblical times where folks were having to deal with inflation. A lot of it maybe had to deal with people artificially inflating things in a non-godly way.
Right.
But there were examples of inflation. I was surprised to see those references in there.
Hmm. Well, I'm reminded of, a scene like in the times that Jesus lived, where there were many marketplaces, right? People buying and selling goods, and as well as strict tax collectors.
Mm-hmm.
Um, and so, I'm just thinking, imagine you're a merchant in the times of Jesus and you suddenly have to pay a tax that you didn't realize it was coming. You're going to have to raise your prices. And
Yeah, exactly.
I'm sure those
Exactly.
markets face that.
I mean, think of all the temple tax that
Hmm.
were had for sacrifices and things.
Right.
Those cause things to go up. Well, hey Jesse, when we come back from the break, I want us to jump into that ugly word called inflation. We're going to give you the update of what core prices hit last month. But folks, you're listening to the Spend Life Well show. We'll be back in just a moment.
All right. Welcome back to the Spend Life Well show. This is Jesse Hamilton, and I'm joined as always by Mark Trice.
Thanks, Jesse. We've been talking about the cost of living increase that's going to happen next year in Social Security. And this is really, those cost of living adjustments are really reflective of a snapshot of inflation. And of course, they normally measure that in July, August, and September every year
Yep.
to see what that might be. And we've had rising inflation during that time. So also, since our last program, we've had the announcement of the Consumer Price Index released. And surprise, surprise, Jesse,
It's high.
inflation is still rising. Inflation is still rising. What was the annualized rate that the CPI hit at last month in
The
September?
overall CPI 8.2%, and we keep saying those prices hit a 4-decade high, but they keep increasing. So that's still true. We're at a 4-decade high here.
Right. And so we haven't seen these prices for you folks, for you listeners that were young adults in the early 1980s, or if you're like me, I was still in school, studying and so forth. But we do remember, our parents having to make sacrifices because things got really expensive.
Mm-hmm.
But the big thing that we noticed is that the core consumer price index, it excludes energy and food, which I think is crazy. I think the proper measure of really where is inflation going is what's the price of food, because that's what impacts everybody, right? We all have to
Mm-hmm.
eat. It's kind of fun. It's one of those things that when we're talking to prospective clients and we ask them about their spending plan, and a lot of them forget to eat, but we all eat, right? We
Right.
all eat, and that continue to rise. The core consumer price index, but it excludes volatile energy and food prices, rose about 6.6%
Mm-hmm.
in September from a year earlier. Now, I forgot what the monthly month over month race was, but it was basically, I want to say, up 0.4, and we were expecting 0.1 or 0.2. So that's huge.
Right.
Um, the the core inflation, though, rose at a 0.6% rate in September, as opposed to just 0.3 in July.
So I don't really
And
understand. I mean, it makes sense from a statistical or economic perspective to remove energy and food because you're taking the outliers out. But
right,
you're so right though that those are our basic needs. We need to get around and we need to eat. So it's I guess it's an interesting economic talking point, but
right.
American, average citizens are not going to be affected by that as much.
Well, I mean, they're going to be affected by the fact that it costs more to buy groceries at the grocery store this weekend. That's for sure.
Absolutely.
I mean, I think what we're trying to say here to our listeners is inflation has built up a lot of momentum over the last year.
Mhm.
And just because an 8.2 year over year number is lower than it was in June, that does not mean that inflation is not accelerating.
Right.
You know, this is really important because what we're seeing here is these core service prices. Those tend to persist. They don't typically go down once they start rising. Those rose at a 1 month annualized rate of 9.9%. That is the sharpest rate increase since 1982.
Wow.
We're seeing a lot of those things rise. Things like motor vehicle repair services rose 2.2% in September. Veterinary services, daycare, preschool rose 2% last month. That's huge. That's a 24% annualized rate. So those types of services tend to be a lot stickier. If you've got a child in daycare, it's not very often that they want to lower their prices, right? Once they raise their prices, they're stuck that level, if not going even higher.
Hmm.
So what we're seeing is that we're going to see these ripple effects of price shocks that over the last year are starting to broaden across the economy. And that's important because when we start seeing the broadening, back in the early part of the year, it was just oil prices that were spiking up, right?
Right.
The fastest, energy prices. Well, that factor out, we're still seeing a lot of increases in the core inflation. And the other thing that was concerning was that we were seeing average incomes per household start to drop. And that's not good necessarily because when you have higher prices and you have income that's dropping, something's got to give, right?
Right. But
So,
what about all these 70 million Americans that have extra Social Security right now? Is that going to add fuel to the fire?
well, it could because if I've got more money to spend, I'm going to be potentially pushing inflation.
Hmm.
So it's a kind of a contagion effect here that okay, we got more income. They're not having to spend as much on Medicare. I've got more disposable income. What am I going to do with it? Am I going to save it? Probably not. That's not
You're,
the
g-
typical response.
you're
We're
going to buy
going to
the
go spend it.
you're going to buy the full tank of gas instead of the half tank.
Maybe so. Maybe so. So, you know, that we saw this accelerate last year because we were recovering from the COVID-19 pandemic, right?
Mhm.
Uh, but then, we had Russia's invasion of Ukraine. That spurred inflation worldwide. We were already having it in the US, but it spurred inflation worldwide, hitting food, energy, and other commodity prices. So, I think what the point here is that all this rising inflation did not give the Federal Reserve the ammo it needed to potentially change course in its effort to fight inflation.
Right.
So
It
last month in September, Jesse, what the Fed raised the federal funds rate by what?
0.75.
0.75, and that brought it in the range of 3.25.
Mhm.
What we're seeing now is we've seen some economists say that they're really going to need to raise that to 5%. And based on what they're projecting for the rest of the year, that means there will potentially continue to have interest rate hikes well into 2023. So, you
Cuz
know,
they can't jump that fast in
well,
one
they
meeting.
can, but it could actually, the problem is usually the Fed's too late at
Mm.
addressing inflation. In this case, they were. And then they're usually too late at taking the brakes off, right?
Okay.
And so, we're already starting to see some signs of the labor market starting to cool off a little bit, but then the next day we'll get a report that says job opening are up again.
Hmm.
So there's a lot of
Conflicting
things that
data.
there's a lot of conflicting data that don't give a clear picture for the Fed to slow down their interest rate hikes, and ultimately what the market wants is a pivot and start to cut those rates,
Hmm.
and they're not getting those signals right now. So,
Well, we
um,
always talk on the show, or we have talked in the past on the show about price stability. That's the
yeah,
word. That's the word that Jerome Powell says over and over. If you listen to his press conferences, he said price stability. And I remember asking you on the show, Mark, what that meant, and it's really that inflation is under control where they want it to be.
right, and it's not. It's their target for price to stability is to have an annualized inflation rate around 2%,
Hmm.
and they're nowhere near that. I think the things that are really um, causing trouble for a lot of households is food prices. They continue to climb. Uh, I saw some figures, Jesse, on grocery prices, and through September they increased about 13% from a year ago. And some of the things that I like have really gone up. I'm the price of eggs up over 30% in the last 12 months. And I'm thinking, I've always thought about having chickens, but I'm really thinking about it now. I'm just trying to figure out where I put them.
Yeah, they can make a lot of noise, Mark.
They can, and I've already got a neighbor that doesn't like my dogs barking at all. So not sure how they'll respond to chickens.
Well, the
Uh,
grocery prices are sneaky, at least for in my household. Our grocery bill is relatively stable, but it could fluctuate 10, 20, 30% based on what we need for that week or that
sure.
month. So this one's really sneaky for spenders because overall 13%, you're not going to really notice it, but I think over time people are going to really be affected by this.
Yeah, I mean, I certainly my wife who does all the grocery shopping and she watches that to the penny.
Uh-huh.
She's really begun to say some things about it. So we're having all sorts of issues with food like that, and the challenge is a lot of people are now burning through their COVID stimulus checks if they save them, and they're starting to build up revolving debt on credit cards and things.
Mhm.
So we were looking at an interesting article in the Wall Street Journal. This was actually back from the summertime, Jesse. This was written by Christina Ricardo, and so this article is entitled "5 Ways Consumers Can Deal with and Even Benefit from Rising Inflation." I think this is kind of important to do that.
Yeah,
You know,
we get several questions from our listeners that say, "What do I do to actually fight inflation? Like, what can I do today to fight inflation?" So I think this would be
right.
a really positive discussion.
And we've been talking about, what makes up inflation and how it affects. I mean, it might impact someone differently if you're riding your bike to work every day, right? So you're
Right,
not
right.
using gas like other folks. Maybe you take the bus or the train, but you still may see those costs passed on. In fact, I think I read an article that municipalities and transportation hubs are going to have to increase their rates for riders coming up in the next year because of those costs. But so we've talked about all those different things. One of the things I think is kind of the sneaky part of the food equation of this is shrinkflation.
Yeah.
And this is one of my pet peeves. I've talked about it at several of our live events and so forth. But it's a tactic that companies used back in the 1970s, and it's coming back. And Jesse, how do companies get engaged in the tactic of shrinkflation?
So they instead of raising the price, they just give you less product without telling you. We've all
Right.
seen the classic example is a bag of chips about it all being air. Why would you pay for extra air? But
Absolutely.
you
And
know, there's grocery stores doing it with produce. Even this article says that toilet paper companies are reducing the number of sheets on a roll.
yeah. And man, I go through a lot of toilet paper in my house with 6 people living there
Uh-huh.
because they don't use it prudently. It's like, "Oh, it's just a toy." And God forbid the dog get a hold of it, right? So, you know, But shrinkflation, this is one of my pet peeves. It always has been, because I do remember a time, Jesse, may have been before you were a consumer at the grocery store, but
Uh-huh.
I remember a time when you bought a bag of chips, it was full of chips.
Hmm.
Okay. Now it might be 2/3 air, and you're getting fewer chips. Now, I know you don't have you and your wife don't have kids yet, but I do,
Uh-huh.
and that means that the bag of chips, I am lucky. I am lucky if I get to have a chip. Okay, because that's how fast chips get consumed in my household. So more air, less chips for Mark. And that really irks me a lot. But there's lots of different examples here in this article.
Mm-hmm.
And the package of strawberries has 5 fewer strawberries. And the toilet paper example is really even more impacting a lot of people. But hey, if you have you been to a Longhorns game or a Baylor Bear game here lately? It costs what, $6 for a glass of
A
soda?
soda, yeah.
Yeah, $6,
I mean, they've
and
always been expensive, but they're going up.
right, and they're charging, giving me less soda. I'm pretty sure they put more ice in there, less soda. So one way to deal with shrinkflation is to try to stick with generic store brands, because those typically tend to be the brands that tend to be the last to shrink, right?
Mm-hmm. I've actually
They tend
noticed
to be the
that.
last to shrink. And if you're paying close attention, if you pay attention to the unit price of what you're buying, some brands just don't usually downsize all their items at the same time. Typically, the largest ones are downsized last. So, you can look at that, especially if you shop at a Costco or a Sam's, where you can buy the giant crates of potato chips,
Mm-hmm.
which would last about a week in my house. You can see and look at the unit cost. And that's the way to see if you're comparing brands, is to see how much each costs based on the unit cost. And so, and a lot of times what we're trying to do in our household is, buy more fresh foods, and those tend to be less susceptible to the packaged foods to shrinkage. So, fortunately here in Texas, we can get fruits and vegetables that are in season pretty much year round.
Mm-hmm.
Another one here is delay Social Security. We talked about the cost of living adjustment in the first segment, but you can also, if you delay past your full retirement age, you can get an additional 8% per year, and this adds up quite a bit. That could be one way to beat inflation. If you don't need the Social Security, you can delay,
Mm-hmm.
and we counsel our clients all the time on that. So, Jesse, was there anything else about Social Security that you needed to add there? I mean, that makes a huge difference, because those cost of living adjustments, if you delay, you're getting, the 8.7% increase on
Right.
top of the increase that you got for that year that you delayed.
Mm-hmm.
So
There's
that
just
really compounds and magnifies the difference.
absolutely, and it's just a part of your greater financial plan. It's a piece of what you need to be thinking about. So a lot of different factors can play in.
All right. Oh, hey, Jesse, we're coming up on a break. Folks, don't go away. When we come back, we will talk about some things that you need to consider for your 401k right now in light of all the inflation and other things going on in the markets. You've been listening to the Spend Life Well Show. We'll be right back. Welcome back, everyone. You're listening to the Spend Life Well Show. I'm Certified Kingdom Advisor Mark Trice, and in the studio today with me is Jesse Hamilton.
Hello.
Jesse and I have been talking about inflation, the cost of living adjustments for 2023 for Social Security, and we were talking about things about how you can kind of deal with inflation.
Mm-hmm.
One of the things that we were discussing here is maybe one thing that you can do is ask for a raise.
Mm-hmm.
I know a lot of people are trying to cap their payroll expenses, but
That can be a really challenging thing to do, because you don't want to seem ungrateful for what you have, but at the same time, there's probably a chance that if your company is doing well and you're doing good work, that you could receive that in a very reasonable manner. Don't you agree?
Yeah, I mean, if you have a good boss like me, maybe and Jesse's not asking for a raise, I hope. But but yeah, I mean, if you haven't had a raise in a while, things are more costly and expensive. Your employer knows that too, because they're seeing higher costs. Maybe it's time to have that conversation
Hmm.
for that. Another one, Jesse, is to really control your lifestyle creep, right? So let's suppose you keep your budgets flat. Your expenses came out to be about $5,000 a month in 2021,
Hmm.
and now try to get by on $5,000 a month in 2022. Okay, that means if we end up facing this inflation for a while, and you're keeping your spending budget flat, that means you have to kind of cut some fat out of the budget, right?
Right.
However, spending inertia is very common, and oftentimes there are some expenses that can be cut without minimal impact. A good place to start is in the budgeting process is to simply pull up your bank account, your credit card or debit card statements, and look for any recurring expenses for subscriptions or services that may no longer be needed.
Right.
If you
There's a
tally up a few of
chance.
those, you can find some savings there.
Absolutely. There's a chance that a lot of our listeners maybe subscribe to two, three, four, five different places to get movies and TV. And
Yeah,
it'd
I was
be,
doing that the other day,
uh-huh.
Jesse, and I was like, wait a minute. I thought we got rid of Netflix a long time ago,
Right.
and I'm still paying for it. And it's just an oversight. I thought my wife canceled it. She thought I canceled it, and
Hmm.
we just never did do it. So look for some of those things. What about shadow inflation? How do we account for that? What's
Um,
shadow inflation? The
well,
example that I remember is like when you used to get free bread and butter
yeah,
at
yeah, I was
at
gonna
your
say at the
restaurant.
restaurant. Uh-huh.
Yeah, yeah. Or when soda refills were free. I haven't seen, some places you could used to be able to bring back your empty cup to the restaurant and refill it, and
Hmm.
that's no more.
In traveling lately, I have noticed that your hotel room doesn't get automatically cleaned as often. Have you noticed that?
Yeah, in fact, they actually the place we were staying at a few weeks ago actually had a little button you could check to say I don't want room service. They're trying to save money that way.
Hmm.
Um, or if you can have it, but they're going to charge you an extra fee. So if you're staying in a hotel room for more than one night and you don't mind reusing the towels, that's probably a good way to save a little money. So, Jesse, I wanted to really talk about the market this last week because we've had a little
Okay.
more volatility. Go ahead
Yes,
and
we
give us
have.
the market update for this week.
So let's touch on the major indexes like we do every time during the show. So starting with the S&P 500 large cap stocks, closed year to date minus 21.95. This is slightly higher than the number that we talked about last week, but it's still well into bear market territory.
Yeah,
And
that's still really volatile. I think it's even down more today.
Mhm,
We're going to continue to see this up and down
right.
cycle. I think one of the things that people that we're kind of seeing is that there's some certain indicators that measure the volatility in the market. And anytime those indicators are above 30 in level, that just means, or really above 24 in level, that just means there's a lot of volatility still in the market. And we're seeing that VIX, the volatility index, stay well above 30. And
Mhm,
that just says that there's more volatility out there and not a really strong chance that in the short run we're going to see markets indices move up very quickly.
right. So let's talk about the Nasdaq, which is the technology heavy index. There's been a lot of headlines recently about companies doing this and that, and certain companies spiking up randomly and others tanking. But overall, the index is down 31.64% for the year.
Yeah. And that was the darling coming out of the pandemic.
Yep, it was. Everybody loved those stocks.
Yep. And not so much this year. In fact, I think the FANGs, the Facebook, Amazon, Netflix, Google type, Microsoft type companies, they're down almost 40%, aren't they?
Yep. 3805. Yeah, very
Okay,
close
and
to
that's an
40%.
index that measures
Right.
those tech heavy, large cap tech companies.
Right, right. So you might own some small caps, like the Russell 2000 index. That's down 21.7% year to date. And then we always talk about the long-term treasury index, Mark.
Mm-hmm. Yeah,
You want to touch on that? I mean, we're down 33.6%.
yeah, and that's typically the financial industry has taught us over the years, or at least tried to drill it into investors' heads, that that's the place, if you want to reduce your stock market risk, that's the place you go put your money. Well, folks,
Right.
it doesn't work that way. And in fact, it really hasn't worked that way in the last 3 bear markets. Yet we're still pummeled with that assumption when we talk to typical financial advisors. And the fact that the long-term treasury index is down even more than the Nasdaq or the S&P 500, that tells you something. And I've shared this fact, so some of your listeners have probably heard this before, but there's only been one other time in the last century where stock market indexes and bond indexes were down more than double digits.
Mhm.
One other time besides this year. And that was in 1931, right in the middle of the Great Depression. Now, folks, I'm not saying that we're going into a depression. Don't take that away at all. That's not what we're saying. You know, we're data guys, and we like to look at numbers and say that. And whenever we see that type of data point, we just kind of make you go, that's interesting.
Right.
Doesn't mean that's going to repeat itself by any means, but it's just interesting that that's the only other time where both bonds and stocks were down more than double digits was in 1931.
Mhm.
So,
So, Mark, would you want to real quick address a listener question?
yeah, let's do that.
Great. So we haven't talked about the mortgage rates yet on this show, but we have in the past. This listener says, "I really want to buy a house this year, but I'm worried about high mortgage rates. How easy is it to refinance my mortgage in a few years when the rates hopefully go down?"
I think just, we've been in this environment where we just expect low interest rates, and
Mm-hmm.
I think the 30-year mortgage with average credit this last week we looked, it was creeping up right around 7%,
Mm-hmm.
maybe a little higher. And for folks that have never bought a home before, that's shocking.
Right.
And for folks that have lived through a couple of economic cycles, we're like, oh, that's normal. And it's all about with your perspective. Now, that means that it's going to cost you several $100s a month for the average price in Austin, priced home in Austin. It's going to cost you several $100s a month more for your mortgage than it did in January of this year.
Mm-hmm.
And that may price some people out of the market. Maybe now's not the time for you to buy that house. Okay. But to answer your question, yes, you can refinance in the future, but there's a number of factors that go into it. I mean, you're going to have to requalify for that mortgage. What if your income situation is not as good as it was today? All right. What if there's a change in your personal financial situation, that maybe you racked up a few credit card bills, and so you're not able to qualify for a mortgage like you did before?
Hmm.
So so the answer is yes, you can refinance if rates go down in the future, but rates may go up for a while.
Mm-hmm.
And so it may be a while before you're able to do that. I certainly would avoid adjustable rate mortgages right now in this environment. They can really get you into trouble if interest rates start to keep rising for the next several years.
Mm-hmm.
I would certainly want to make sure that you are trying to get a mortgage that fits within your budget. We don't like to see you spend more than 25% of your gross income on any type of living expenses. So you need to keep those in mind with that. And you need to make sure that you have a good solid down payment for that. But shop around, talk to your bank or some mortgage brokers that are in the area, and compare, because I have seen some discrepancies. Some builders are buying down interest rates for consumers of new construction. Some mortgage brokers are actually being a little bit more competitive than others. So don't just accept the first interest rate bid that you receive from your
Hmm.
banker. Shop around, do a little homework, see which company might best serve your needs.
All right,
We have
thanks,
another
Mark.
question, Jesse.
Yeah, you're gonna like this one.
Okay.
It says, what should I do if I'm a younger investor, say 20 plus years from retirement, but I'm still worried about putting my 401k in the market?
Jesse, what does scripture say about worry? We
That we
cannot
should not
worry.
worry.
We should not worry about tomorrow. Today's enough, right?
Uh-huh.
And if you have a long investment horizon, 20 years or more, as this listener has, this is a great time to start dollar cost averaging into your 401k. The most important thing that you can do is simply to start.
Hmm.
And now when things are on sale, I mean, you're not plopping down $1 million. We're starting with a few $100 from our paycheck when
Hmm.
we're talking about our 401ks. This will help you immensely. I remember when during 2002, and I was working for a firm and a new 401k and stuff, and I was amazed about how much my 401k grew after the 2000 to 2002 bear market. It grew like crazy, something like 100% in just a few years. Now, I'm saying you won't have that experience, but starting now and keeping at it and being systematic and about your approach, having something come from every paycheck, guess what? You're going to be ahead as you get closer to retirement. So that's a great question. I encourage everybody to keep investing. You don't want to necessarily stop that, and if you're starting, please do that.
Hmm.
So, Jesse, in our remaining time, I wanted to talk about. We have an article from one of our advisor friends in Minnesota, and he was talking about the ABCs of 401k mutual fund picking. We see all sorts of different types of behaviors when it comes to trying to identify the best funds to choose within our 401k plan at work.
Hmm.
And we've seen lots of different behaviors. We've seen things like um, if there are 10 mutual funds to choose from, people will put 1/10 of their money into each one without any regard to what's actually there. Yeah. And we talked about on this show before, Jesse, that one, I won't name it, but it had a name something like low price stock fund.
Yeah.
And guess what? What did everybody do with that? They thought it
They
was on
want,
sale,
yeah, they thought it was
right?
on sale. They wanted it.
And it turned out to be an extremely volatile mutual fund.
Probably
And
some sort of high yield bond type thing.
well, it was actually a micro caps type stock. I don't even know
Oh,
why it
okay.
was in. I don't even know why it was in this
Micro
particular.
cap in a 401k. That's very
Yeah, that's why I
surprising.
don't know why it was in there, but it was extremely volatile. And in 2007, 2009, boy, it lost a lot.
Hmm.
So we have these biases. One that our friend uh, Rick talked about from Minnesota talked about alphabetic. I can't even say it. Alphabetic
Alphabeticity.
bias, right?
Yeah.
Alphabetic bias. Because if you've noticed, a lot of times 401k plan providers will actually list the funds that are
Hmm.
available in alphabetical order.
I made this
And
terrible mistake with my fantasy football team. I wasn't paying attention. I just clicked the top three guys, and they were all three named AJ.
and so I guess you're not doing too well with that.
Not doing
But
so well.
so the rankings there and how they perform are completely independent of what alphabetical order they're in. And they've actually done a lot of studies that say that there's a higher propensity to choose the first two or three on the list. And they could be all the same type fund. They could be completely different. But watch out for that bias. Watch out for the biases we have. It's really important that you consult your plan advisor. They do have resources available to you. you can give us a call at 254-282-0495 or visit us on our website, spendlifewell.com. We'll help you take a snapshot of your current situation, your 401k, and give you some suggestions. But you got to think about it this way. This is not, you if you're doing your NCAA men's basketball tournament bracket, you don't pick them, based on just the color. Although I do know some people that do that for pick on colors of the mascot. But you want to look at the strength of those positions, the strength of those funds. So anyway, hey Jesse, we're coming up at the end of the program today. It's been another successful broadcast, folks. We are so thankful that you've taken a few minutes to listen to us. Like we said, you can give us a call anytime. Visit us at spendlifewell.com. Lord willing, we'll be back next week. We pray that you have a blessed and peaceful week. Thanks for joining us.